Welcome to Insider's Dealmaking Podcast, where we're going to take a big picture view of mergers and acquisitions and how these affect your companies. But we're also going to get down to granular level on the values, the cash, the obstacles and the opportunities of a good deal for your business. Hi, and welcome to the Insider Podcast. I'm Kurt Jacobs, the editor of Midlands Business Insider. And today we're going to be looking at the prospects for deal making, M&A. What's driving the sector? Where's it going? What are the opportunities for your business? And to help us, we've got three experts who really know the subject. And perhaps you can tell us about yourselves and why you're here. So start with you, Ian, please.
Hi, I'm Ian Wright. I'm the founder of Claritas Tax. We are a mid-market tax advisory firm focused on a lot of transactions as well as wider tax work.
Hi, I'm Helen Brockbank. I'm a mergers and acquisitions partner at RSM UK. I specialise in working with business owners, helping them execute and complete transactions, whether that's taking a long-held business to market, sale and exit, or acquisition, growth or fundraising.
Hello, I'm Chris Handy. I'm a partner in LDC and I'm responsible for the West Midlands business of LDC, the West Midlands region. We are private equity investors. LDC has 400 million of capital to deploy annually into SMEs. So we're looking to back ambitious management teams to help them achieve their growth ambition. So my role is to deploy that capital in the West Mids region.
What I'd like to do to start the conversation off is, let's take the big picture view. Let's look at what's driving mergers and acquisitions across Britain, what's holding them back, what the big dynamics are. I'll start with you, Chris, if you can. Sort of give us the big overview of where you see the sector at the moment and where you see it going, perhaps over the next 6 to 12 months.
We're in a tricky period, I would say, at the moment certainly for private equity investment, for deal volumes generally. I think if you look at Q2 of 2025, it's ahead of Q1 in terms of both value transactions and number of transactions, but it's well down on the comparable half year last year. Some of the factors that are driving that, I think, are some of the macro uncertainty that's around some of the impact of things like tariffs have caused a degree of friction in the market and delay in getting deals done. There's plenty of appetite to do deals. There's more private equity dry powder available than there has been for some time. So there's certainly a desire to get deals done. And still in certain sectors, deals are getting done and are getting done at premium pricing, actually. But that's quite sector specific and quite narrow. There are other parts of the market where that degree of inertia I mentioned is very prevalent.
So you say the appetite's still there, and that's not going away, but
there's plenty of appetite. And I think PE firms are finding ways of doing deals. So, for example, bolt-on transactions is from an LDC perspective, we roughly have around 90 businesses in our portfolio across the UK. We've already done 20 bolt-ons this year across that portfolio. We did something like 50 last year. So I think PE firms are finding ways to do deals and trying to innovate. But there's no hiding the fact it's difficult. I think there are signs that things are picking up a bit, and perhaps we can chat a bit more as we develop the conversation around that. So there are some signs that there's more activity coming. But so far it's been a tricky market, I would say, this year.
Helen, I saw you nodding a lot through that.
Yeah, and I think the challenge has been very much just the extreme volatility. I think if we did the terrible thing and look back at all our predictions towards the end of 2024, we sat there as a market thinking, okay, Trump should fundamentally be a business-friendly administration. Finally, we were maybe in some sort of at least a bit of political stability in the UK. And then actually with the tariffs, with continuing uncertainty, just that complete unpredictability makes it incredibly hard for business owners to know when to invest or when to realise this investment, and likewise for investors. So I think it's just put that brakes on, added those friction points, let alone the impact that has then on consumer confidence, and that trickle down to the market, to business sentiment.
So is that actually stopping transactions or just simply slowing them?
Given what it's that, I would say in the main slowing, and that might be characterised as a hesitation to start a process, to decide to sell, or actually it might be that the execution for transaction from that first bid through due diligence, through the assessment of the business, just takes that much longer as people consider, well, actually as trading progresses throughout the year, how is the business coping with a macroeconomic environment that's always changing by the minute?
Ian, what are your thoughts?
And certainly we're seeing activity. A lot of the activity is not coming, sadly, from the Midlands. It's coming nationally, and it's very much focused on particular sectors where they're very hot. I think overall there are bigger changes, a lot of which have been caused by the Chancellor. We've talked about, with a lot of clients, we've talked about the changes to inheritance tax and how that is now affecting people in the way they're looking at their businesses. People have to make conscious decisions now. It's no longer acceptable to hold a business until death. You've got to be thinking, I need to get cash for this business. So people are certainly looking at it differently in that respect.
I really want to pick up on that later. We talked about a few moments ago about, I think you used the phrase, how sticking to the market we're in is uncertainty. Let's look at what's the hot sectors and what's the cold sectors. I mean, sort of, this is going absolute gangbusters and this is leave well alone.
I think you could almost characterise it to start at the very high level before we start to drill down to the potatoes. It's almost what's driving the sectors that are hot. And I think it's those resilient areas which are counter-cyclical, which may be driven by regulatory factors, that fundamentally, regardless of where the economic cycle is, this spend has to take place. So hence you're seeing a lot of interest in professional services, a lot in testing and certification businesses. So I think that you characterise healthcare. So almost that's the driver, because actually it's that resilience. So that's giving confidence. And then I think you drill to that to where actually you're seeing some real heat in the market.
I'd echo Helen's point, actually. I think investors are looking for resilience. As you mentioned, they're looking for recurring revenue. So there's been professional services, business services been a very, a sector that's attracted a lot of investment. Today we've seen, I think, the Higgs deal announced, which is a pretty well-known.
It's a well-known law firm in the Midlands.
Well-known Midlands law firm. We've invested in Harper James, another legal services firm, and probably if you wind the clock back for the last 18 months or so, there's been a lot of money going into the accountancy sector. Some notable large deals. Grant Thornton, Cinven has gone into Grant Thornton, and there've been multiple other deals, and I think those are driven, as Helen says, by, if you look at the business fundamentals, those services are going to be required in any economic scenario, and from an investor's perspective, if you've got recurring revenue, which is the point about some of the audit models, and some of the legal firms in terms of their service offerings, then that's going to give an investor confidence that that business will continue to grow, regardless of the macro situation. Again, healthcare is a sector that's resilient. Infrastructure, something that's related to infrastructure, should also be benefiting from what the government has been doing. So, we're an investor we've got an investment in IDSL over in the East Midlands, and that's a manufacturer of fire doors, and a lot of those go into hospitals, for example, and that they're required and they get damaged and replacement of those is required. So that's a business that's super resilient to what's going on in the market today.
So you're looking at resilient businesses, and you say things like healthcare. You're not just looking specifically at drugs and beds and so forth. You're thinking 2-3 steps down the line. Things like doors, which simply wouldn't cross most people's minds. No, I'm not looking at it.
Well, in that case, that's those are specific fire doors for, and there's a safety case for them. Our investment model is to back ambitious management teams. So although we do think carefully about sectors, we don't start with sector. We start with the best management teams in the regions that we're looking to support. And so, in some respects, the sector is perhaps less relevant. I think the question started with what are the sectors that are attracting investment at the moment, and certainly, as Helen pointed out, healthcare, business services. Technology is a broad subject, but clearly, there's a lot of thinking going on around the impact on AI, both on our deal making, the jobs we're doing, but also in the broader economic sense. So that tech is still attracting investments.
And actually, if you take then that the AI, which is a catch-all for many things, that isn't just necessarily impacting. We all think about the core technology, but it's the infrastructure that then sits. So I have a fairly significant focus on sort of industrials, and actually it's the infrastructure around kind of power, around the investment in data centers globally. Actually, that's driving a lot of investment in that sector, and that none of that is probably a safe investment. There's a lot of uncertainty, but clearly the demand for AI is only going to go up, and that's just driving more and more investment.
As a sector, it's going somewhere, and people feel they have to be on the train.
Probably, absolutely, yeah.
I think that's interesting. Sorry, I was just going to say, coming in on that, you're talking about the infrastructure around AI, and you look at how Rolls-Royce and their share price is blossoming and booming because of their ability to support AI and the massive need for energy that there is as a result of AI.
And then I suppose there's a slight link of a sector that we haven't talked about for a very, very long time, which is starting to get traction, is defence. Nobody's really talked about putting any money into defence, and has probably been a very difficult area for a lot of funds to explore as well. But actually with the push from the US and then greater commitment across Europe, actually has started to get some real traction.
Actually, defence is a good one. Perhaps just in passing, to take a bit of a fly here, is the thing, what's happening in Ukraine and so forth, almost, I hate to say, legitimise defence as an investment thing. It's something a lot of businesses try to avoid because of the negative connotations, but now
I think
it's seen as positive. Yeah.
Yeah, I mean, when you're defending yourself from the Russians, that's very different from selling arms to dictators in Africa, isn't it? It creates a completely different environment, creates a completely different way of looking at things.
Okay. We talked about areas that are hot. What's cold at the moment? What sort of, perhaps not when it comes to investment?
I mean, I think leisure and hospitality is challenging, certainly in terms of anything with a high staff demand, the impact of national insurance from quarter one this year has just made so many business models incredibly challenging. I think I'd say anything that's really driven on consumer demand is tough at the moment.
I could see you nodding a lot there, Chris.
I mean, as I say, my role is to find ambitious management teams, so I wouldn't rule out those sectors if I've got. But the challenges those sectors you mentioned, Ellen, are facing is growth, because we're looking to back teams to grow businesses, but if their market conditions are tough and they're facing cost headwinds and they're facing challenges to deliver both top line and bottom line growth, then that makes it hard to attract investment. So I think that's a consequence of the market point, really. So I agree with you.
Okay. What are you thinking? What's cold for you? What sort of you seeing the market sort of has chilled a little, shall we say?
I would agree with what Helen and Chris have said. It's people dependent businesses, particularly where you've got a lot of relatively low paid people.
Yeah.
Those are really difficult sectors to get interested in at the moment.
I'm glad you raised low pay, because you've obviously been looking through my notes for what I was going to raise next. Let's talk about tax, and at the risk of lighting the blue touch paper with you and standing well back. What's been the impact so far of tax changes under Labour on deal making, both good and bad? And what do you see as possibly coming up and the implications thereof in the next 12 months? So let's say Rachel Reeves in her next statement says something. What might you expect in it, and what do you think the impact could be? But let's go back to sort of those initial changes.
Yeah, so I mean, we all saw a massive rush to the exit last October before the capital gains tax rates increased. We've already
People were trying to sell that.
People were trying to sell immediately before the capital gains tax rate went up, because we didn't know what the rate was going to be, but that made a difference between 20 and 24%. And if you were selling a large asset, 4% is a significant amount of money to lose overnight. So people were very conscious of that. And we had an acceleration. I don't think we saw more activity. I just think we had an acceleration. So we had a quieter November and December because we had a busy October. Yeah, absolutely. I think what we're seeing now People are starting to talk a little bit about whether there might be more changes this year. But I think there's almost an acceptance that it may go to 25, 26%, because once you start notching up the rate, it's easy to carry on adding 1 or 2%. And I think it almost gets baked into people's expectations that it'll go up another 1 or 2%. And then you're into a boiling frog scenario, aren't you? At what point does the frog no longer jump out but realizes it's been boiled to death? I think that's the danger at the moment, isn't it? We carry on ratcheting up. I think what we are seeing is a change in behavior from vendors when it comes to tax planning. For most of my career, we had a very benign tax environment. We had, up to 2008, we had unlimited gains at 10% with business asset taper relief under Gordon Brown. Since then, for most of the period since, we've had a £10 million lifetime limit for entrepreneurs relief. Now we have £1 million. And for most substantial businesses, you're now paying 24% capital gains tax instead of 10. And what we are now seeing is a mindset change in terms of what people want to do. A lot of entrepreneurs we talk to are no longer happy to invest and reinvest in the UK. 5 years ago, we would have never talked to anyone who wanted to move abroad. Now, we probably talk to 4 or 5 potential vendors every month about whether they might move abroad.
Really, it's that many.
And we don't necessarily do 5, but because there's a lot of practical considerations before you actually move abroad. It's not an easy thing to do. If your life is set up in the UK, if you've got parents in the UK, if you've got children in the UK, moving to Dubai may sound great, but the ramifications are great. But nevertheless, we're seeing an awful lot of people looking seriously at where they go and whether they would rather move abroad for 5 or 6 years, pay 0 tax, potentially, if they can get it right, and move to somewhere like Dubai, Gibraltar, Malta, Cyprus, even places like the Channel Islands, which historically people never really looked at because they were expensive. But people are looking at those sort of places because they don't want to lose a quarter of their investment or their return, their lifetime's work in tax.
I completely echo that. I think we've had more of those conversations. That it's a different point from how many people have the conversations, but there are certainly more people going offshore. And one of the joys of my role is, especially when you work with a business and maybe a founder exits, the exciting thing is often the phone rings a couple of years later. I've done something else. I've got an idea. I've got a new plan. And to lose that entrepreneurial spirit when people go offshore, I think is just a massive loss to the economy.
You know, that's something I hadn't thought about, Helen, which is it's not just sort of loss of revenue. It's a loss of entrepreneurs. It's sort of, I hate to say it, I know lots of entrepreneurs sell up. You just go retire to the southwest to play golf, got bored after 6 months and decided, what else can I do? And there's a danger we might lose that long term.
Absolutely. Yeah. And I think that's, aside from the tax, I guess the more tangible tax revenues, it's losing that spirit. I guess my view is, do people, there is the end point, does the end point as tax revenues grow, as the tax demand grows, does that stop people founding businesses? I don't believe it does, or we certainly haven't seen any evidence of that yet. But I think it's that loss of the real kind of strength and drive in the country of where people actually do look to move away.
Yeah, I think what it does also, as you say, it doesn't stop people starting businesses, because there aren't, other than the serial entrepreneurs, the people who've done it once and know what's required. I don't think many people start a business with a view to selling it, but once they've started it and made it successful, they then think about what the options are. And do you work 7 days a week, 18 hours a day, if you think that the government's going to take an awful lot of it while you're working, and then 25% of it when you decide to sell?
Chris, you got any thoughts on this?
I think from my perspective, I'd pick up on both the points you've raised, really, because my role is to find ambitious businesses and back them. But we found that we're most successful when we back UK-based management teams. So, and quite often you do get what's just been described as a serial entrepreneur who may do multiple deals. And so I would be concerned if about that move offshore, because that reduces the pool of potentially high quality management teams that I can back. So I understand the point that's being made, and it's something that I'll be concerned about, I think, frankly.
The other thing we are seeing, which could be positive, is people looking to structure their sales more. So during the peak of entrepreneurs relief or the business asset taper going way back.
So what was that? So just explain what that was, if that's okay.
So people are thinking, at one time you would take your 10% tax and you could do whatever you wanted with your money. Now people are thinking if they want to reinvest, or if they don't need to spend and they're never going to need all the cash that they're realizing from a sale, then what do they do with it instead? So we're seeing people using trust, because that helps with inheritance tax and helps with incentivizing the future generations of their own family, protecting family wealth. But we're also seeing people using things like family investment companies, structures like that allow them to reinvest their proceeds through a corporate vehicle. If it's done properly, paying less tax on initial sale, and then being able to reinvest gross proceeds. And actually, if we look at that, that could be very positive. I think it's an unintended consequence, but it could be very positive for the UK, not just steel market, but for the UK economy.
Can I pick up something else? You mentioned it in passing a few minutes ago, I'd like to put on, which is the other big change, of course, is two of the big changes, obviously, were national insurance and inheritance tax. I remember speaking to the heir-to-be of a family business about a year ago. And so you chat with his mother, she said, what should do? And he said, well, bluntly, die now or die in 7 years.
Yeah.
Well, what impact is that having? We mentioned earlier, inheritance tax changes. It's been taken up by the farming community, who've realised its implications fairly quickly. Among the broader business business community, I don't think it's really sunk in yet.
No, I think it's taken some time to kind of permeate, and I don't think we're quite there yet. But I think there's always been that thought, especially for very long-standing family businesses. Oh well, I'll carry on, and if something happens, well, worst case scenario, it's an efficient asset, and my family can deal with it. And I think it's getting those messages out, and it's on us as advisors and the rest of our market to talk to our clients, talk to business, and make people aware that straightforward route, if the worst happens, just isn't there, to actually build structural planning in there. There's certain time frames. We've talked about trust. There's a bit of a ticking time bomb of options as we stand now to the end of the tax year. But I think it is certainly getting that message out. If I take a positive spin out of it, in the a here, actually, it's that really people having a conscious conversation and thinking about what their personal objectives, the strategy, and not just that path of least resistance. Because in reality, that's probably the most positive output for any business anyway, to make a conscious transition of management rather than a unplanned structure.
Can I come to you, Chris, perhaps moving the conversation on a bit, is I want to look at cash, as it were, and access to it. So speaking from an equity viewpoint, but also somebody, most buyers and so forth, are a mixture of debt and equity. How do you see access to finance at the moment, both in terms of availability, but also in cost, and where do you see it going?
I think in terms of access, then there's more dry powder around in private equity today than there's been for quite some time. So I don't think there's any shortage of
dry powder is just the amount of cash that's available.
Sorry, amount of funds raised that have not yet been deployed.
Yeah.
So lots of PE houses have raised funds. So there's private equity capital to deploy into the market. From a debt perspective, I think the banks have started, the clearing banks have started to come back into the market. There's private credit available, and clearly from a cost perspective, interest rate movements downwards has helped. Where it goes going forwards, I don't really have a crystal ball.
Don't love one.
If I could predict that, then we could go and place some money in the casino maybe. But I don't see access to capital as a barrier to deal making, which is where we started in terms of talking about the market for M&A transactions in the UK. I don't see access to capital as a barrier. and I don't think that's going to be a barrier for the foreseeable future. I think the issue more is finding quality assets to invest in, and actually back to the point we raised earlier around that inertia, stickiness in the market, then is getting those deals moving. And as I said before, I think there is some signs of activity picking up.
It's that appetite to risk. The banks have funds, obviously private equity does, even asset-based lenders. I think what you see, it's that flight to quality. So those resilient, perceived as less risky businesses, certainly within some of the larger clearing banks, assets or businesses where they have a long-running relationship. Actually, there's that, I guess, visible pathway of paying down debt. Any process involving, I guess, a known asset is going to be significantly more straightforward. Newer, less certain sectors, it's a sliding scale of risk and cost. And actually, on a fairly positive note, I guess the banking environment, the spectrum I would say we have around that debt to equity, which I wouldn't put in buckets and would maybe look as more of a spectrum, actually is a pretty fluid environment. So for a very reasonable proposition, even something that might not sit in the realms of the clearing bank, there are some pretty good options for most businesses out there. It might cost them more, but somewhere in that spectrum between what might be debt and what might be equity, there should be an answer.
So the usual thing, because it used to be, I'm going back a few years now, it was private equity, it was your main clearing banks. That was it. Now there's a whole range of alternative lenders out there.
Absolutely.
Lots of flavours.
Yeah, and that's it. And that's everything of that step that's closer, be it private debt funds or debt that might take some sort of warrant over shares, and lots of little variations, some of the challenger banks. So I would see it as a sort of fairly positive outlook, but it's having to be creative. And I would say actually the value of a good debt advisor can really help unlock some less obvious solutions.
Well, somebody described it to me, what was it? We've gone from vanilla financing to tutti frutti. Basically any flavour you like.
Correct, yeah. Which is a positive.
Yeah.
Yeah.
Okay. Well,
So cost of capital is still above 2022 levels, but at least it is trending in the right direction.
Yeah. And I guess real cost, when you take inflation into account, is pretty reasonable, isn't it?
Yeah. One thing we mentioned in passing, and it's still with you, is uncertainty is the US. And should we say Donald Trump divides opinions amongst many people. So without being sort of Trump-phobic or a complete MAGA enthusiast, what impact do you think the relationship... Actually, let's stretch it not just to the US, but internationally generally. We'll start off with Trump. That's having, and how do you see the international prospects for that? Because speaking to deal makers, I've got the sense now when it comes to transactions, you're now thinking globally. You can not just thought of, I'm going to sell to the bloke down the road. It really has to be a global perspective in which you're dealing in.
100%. I mean, there's just so few circumstances where actually thinking UK is enough. It feels incredibly parochial, and not to have even considered a global outlook would feel foolish in this day and age. I think there is still a huge flow of transactions between the UK and the US. It's a huge part of our market, and there's a lot of interaction with us and our US colleagues. And actually, I suppose the dollar's moved unfavourably for the US. It's made us slightly more expensive as an acquiring asset, but that doesn't really seem to have staved off that level of appetite. I think fundamentally, yes, Trump is driving uncertainty, but what I am seeing with a lot of businesses is actually trying to look through that. Barring anything that would be breaking the Constitution, Trump's administration will come to an end. Things will change again. And actually, business looked through that, maybe see some uncertainty as an opportunity and take advantage of that and invest while maybe not the whole market is running after them.
Well, I was speaking to someone a few weeks ago, and he was saying exports plastic trumpets and actually makes a really good living from it. But saying basically, if 10% is what I have to pay for accessing the biggest market in the world, so be it.
Yeah.
It's a pain, but I can live with it.
Yeah. Yeah, I think the interesting thing with not so much Trump, but America generally, is that their economy has grown so strongly over recent years. Certainly since the financial crash, the rebound from that has been astronomical in the US compared with what we've had. I mean, I was there on holiday earlier this month. There is a vibrancy, there is a buoyancy in the whole country, not just in business there. I think they will carry on being a powerful force in our market.
Join us next time for more great conversation. If you want to take part in one of our podcasts, please get in touch.
From 3.5%-4% growth every year, then almost why wouldn't they see UK assets or assets anywhere else as attractive? Because they can then, if they're good businesses, they can hopefully benefit from their higher growth rates.
What about you, Chris? You say you need to buy and build in a big way at the moment, to build developing portfolios.
So I mean, although we're a UK SME investor, so we're investing in businesses that are based in the UK. Most of our businesses are not only trading in the UK; they are trading in export markets as well. So I think that the impact of tariffs, if we're talking about the US and what's happened recently, that needs to work its way through. I think Helen's right. There are businesses that are finding ways through that, but that has caused uncertainty, and inevitably, investors don't like uncertainty, and therefore that's probably one of the causes of the friction and the delay in the let's get more information and see what happens, and that just builds that inertia stickiness we talked about earlier. But broadly speaking, I think I agree with Helen. I think businesses will work through these impacts and they'll find ways of dealing with it.
One thing I'd like to come to is valuations. I mean, some people watching this, let's be honest, we're rubbing their hands and say, okay, how much is my business worth? I don't think we can do that here, but as you say, probably could. But what
Might need some numbers.
But what do you see into valuations? I mean, you used a beautiful phrase beforehand, bifurcation of the market.
Bifurcation.
Yeah. A quick explanation of how businesses are normally valued when it comes to a purchase or a sale. So
Okay.
the idea of the multiple.
Do you want to do this?
Oh,
Go on.
I mean, there's people spend their whole careers on different ways of finding the market, but much as we like to sit around this table and pretend we're very clever, actually the majority of profit-making trading businesses are valued in a relatively straightforward manner, which is thinking about the profits they generate. We love a good acronym. Frequently that will be EBITDA, earnings before interest, tax and amortization, effectively an equivalent for the cash business is generating, and apply a multiple to that. And that multiple really is to give a sense of, actually, for a buyer, how many years future profits are they willing to pay for? And that assumes, and that multiple will vary on basically really how fast do they think that business is going to grow, and therefore actually they'll be able to recruit their investment sooner. That's hopefully a small precis on it.
Brilliant.
So having had that technical explanation,
over that.
yeah, thank you for that. Bifurcation, what's that mean? Well, I think what we talked a bit earlier about sectors that were still driving significant deal flow and perhaps sectors that weren't. I think actually from a valuation perspective, for those sectors that are still attracting high degrees of interest, their valuations are probably as high as they've ever been. Actually, I think in sectors that are perhaps not quite so buoyant at the moment, then I think one of the points of inertia is that the expectation of value in terms of multiples, I'm not sure has corrected between buyers and sellers. And I think that's one of, there are lots of factors that, we've touched on, but I think that's one of the factors that's causing some inertia. I think bluntly speaking, if you're selling your business, you're probably looking still for last year's multiple, whereas in reality, in a sector where there are a lot of headwinds, perhaps there needs to be a correction. I don't know that that's, well, you'll have a view. I'm not sure that's fully washed through yet.
Is that sort of basically you have the pleasure of telling somebody their life's work isn't quite worth as much as they thought it was going to be?
It's not an uncommon scenario. And fundamentally, when you're having a conversation with a potential client or a business that you're looking to invest in, actually it's having that. Sometimes it is a difficult conversation, but actually talking through the real drivers of the business, thinking about what's going on in the market. I'd rather be really transparent with somebody going into a conversation, a relationship, rather than that there's a disappointment down the line.
I take it that's an issue you've come across a lot, which is basically sort of, right, okay, giving you a piece of tax advice. You're not going to have to worry about this as much as you thought you would.
The importance of tax planning.
I'm very aware of time, so what I'd like to do, if it's okay, is perhaps to wind up, which is a big takeaway thought, a sort of, from each of you, I'll start with you, Ian, and work our way around the table, is a plea, a prediction, a warning to a business owner who is looking at basically buying or selling or getting some decent investment. What should they keep in mind over the next 12 months?
I think realistically, the big thing that we all look at is what is left in the bank at the end. Because whatever the multiple may be that Helen can achieve, whatever price Chris is willing to pay, it's what is left at the end. The sooner you start planning for that, the better the outcome is likely to be. There are lots of opportunities for people to do things, and it's probably more important than it's been in 20 years. I think the plea I would have is, let's have fewer changes. We're already going into an autumn where everyone is petrified of what will happen. It feels like this time it's going to be pensions and property that will be hit. Last year clearly was employment and capital gains. So that may mean there is a bit of stability within the market for the next 12 to 24 months from a tax point of view. But I think, people need to think about what they want to do, what they want to achieve, how they want to manage things. Start thinking about it as early as possible.
And I think we've talked a huge amount about uncertainty, volatility, change, and actually I think it's how to help business owners to navigate through that. How do I decide when to invest? Do we just do we put everything on hold and make no progress? Actually, it's looking through that, and it's really just stepping back and thinking about those themes, that strategy. What are some of the key drivers in those macroeconomic trends, be it climate change, be it supply chain variability, actually looking through that, thinking how your business fits into that, thinking about your strategy, thinking about your personal objectives, and then how that fits with the world around you, rather than actually getting lost in all this noise and all this change, because actually a solid strategy and one that is driving to your personal objectives actually will cut through short-term noise.
Well, Chris, as the man who holds the money, is it 400 million quid? Basically, if your advice to somebody who wants to get a bit of that, what would it be?
So I think that to echo what both Ian and Helen have said, I think the conversation and moving the conversation on is critical. And my role in LDC is to back ambitious management teams. And to help them grow their businesses. We exited 12 businesses last year. Of those businesses, they've grown their revenues by 263% across the board and created more than 3,380 jobs. So I think private equity can be a force for driving that growth. And I think I'd encourage entrepreneurs to have the conversation if they're seeking capital and, look with the likes of the skills that Ellen and Ian bring to the table, look to structure a transaction that can work and can happen and can achieve the stakeholder objectives, and perhaps try and unlock some of that friction and some of that stickiness, because I think there's, as I said before, there's capital to deploy, and I think we can be a key part of driving that UK economic growth story, and that's above all else what the UK needs right now is a stronger growth story. So we're open for business, and I'd encourage entrepreneurs to to have the conversation with advisors, with capital providers, and start the conversation. I think that would be my wish.
Thank you very much. I think that's all we've got time for. I'd like to thank Claritas Tax for sponsoring this morning's event. Hopefully you've taken away some ideas about how you can improve your business. Thank you very much. Join us next time for more great conversation. If you want to take part in one of our podcasts, please get in touch.